Massive amounts of spending on artificial intelligence have led to a wave of issuance in the bond market. But amid concerns about an AI bubble and the risks in the private credit space, what does it all mean potentially for corporate bonds? Joining us now to discuss is Ben Chim, Managing Director and Head of Credit with TD Asset Management. Ben, great to have you back on the program.
Thanks for having me, Greg.
All right, so let's dig in. We got a lot to go through here. What is the general environment now, the general outlook for corporate bonds right now?
Yeah, I mean, right now, corporate bonds have actually held in fairly well. When you think about the headlines, think about all the volatility that's going on in the market. Credit spreads, which are your risk premiums that you earn for being in corporate bonds compared to government bonds, we have seen them risen a little bit, which is expected with some volatility. But investment grade spreads are up about 12 basis points off of the lows for this year. In high yield, you're seeing spreads underperform, so they're up about 60, 65 basis points from the tights for this year. When you look at where they are from an all-in basis, U.S. investment grade spreads are about 85 basis points, 86 basis points right now. And in high yield, you're talking about a spread of 330 basis points. When you think about what that means historically in the last few years, it's still at the tighter end of the range, and really actually the tighter end of the last 10, 15 years. So what that's saying is credit markets are still fairly calm with everything that's been going on. And what's really kind of supporting things and driving this calm is the fact that overall corporate earnings have been very strong. So if you look at the third quarter, just some of the numbers, investment grade companies in terms of earnings, they were up 14% year over year in the third quarter. High yield, a little bit more of a mixed bag. Earnings were up only 1% to 2%. But importantly, in high yield, more than twice as many companies beat earning expectations compared to miss them. So what this has created is a backdrop where credit investors themselves still fairly confident about the fundamentals and confident in light of the concerns that we're seeing, right? The labor market is fairly weak in the US. There's a lot of challenges that companies are trying to deal with regard to tariffs and trade and whatnot. And of course, as you mentioned, there's all these recent questions around AI, the spending, and are we going to get our money that we expect to, that we expect to earn from all of this. So from a fundamental perspective, we think it's going to be a tailwind in terms of supporting the credit markets going forward. And the bigger question, as you mentioned, is where are things from the supply perspective? Is the technicals going to hold up as well? We think they're going to be a little bit more challenging over the next year compared to what we've seen in the last few years. M&A spending, M&A activity has increased, and that's going to need to be funded. Of course, you got major hyperscalers coming to market in the last month. A number of jumbo deals have come out and issued. And so that has left the market wondering how much more is to come. And so there's a little bit of nervousness around that. But when you do look at all-in yields in the credit markets, you're getting high quality credit in the US investment grade space, you're getting 5 to 6% yields there. In the Canadian investment grade space, you're getting yields 3.5 to 4%. In high yield, the higher quality high yield companies give you yields of something close to 7%. So still enough to really continue to attract money into the asset class, and investors continue to want to get those yields in corporate bond space. And between that and fundamentals, we think that sets up for a fairly solid 2026 for corporate bonds overall.
That's the backdrop, and heading into 2026, as we are getting closer and closer by the day. Let's talk about that wave of issuance and artificial intelligence and that space right there. It does raise some concerns about the supply, about the potential for a bubble. How are you reading that market?
Yeah, as you said, we saw 3 major hyperscaler deals come in the last month or so. Facebook came twice. They came on balance sheet, and they also came off balance sheet. So they backstopped a deal of a hyperscaler or a data center build by Blue Owl. We also saw Alphabet come to market, and Amazon did a jumbo deal. All in all, each of them raised between $15 to $30 billion of debt over the month. So it's a lot of money, but it actually was fairly comfortably absorbed by the market. And the reason why is these are some of the strongest credits in the corporate bond space. And so, investors are still very willing to lend to them. But what has happened is the knock-on effect is a lot of investors are now scrambling to wonder, how much more is there to come, right? Is there going to be a lot more debt issuance? How should we think about that? We've done a lot of analysis, and a lot of others have done that as well, trying to sort of figure out what to expect. It isn't just data center spending, right? It's spending on power to deliver to the data centers. It's spending on other parts of the infrastructure as well, software, telecom capacity, things like that. And when you kind of put that all together, it's obviously a big guess, but we're hearing numbers something between 300 to 500 billion in terms of spending every year for the next 3 years to 5 years. That's going to be incrementally needed to be funded by the credit markets. So that's a lot to come, and it's caused credit investors is to kind of pause and say, well, we need to get compensated a little bit more for that. And so undoubtedly, that's been a part of why credit spreads are not at the tights today. And we think that's going to continue to cause credit spreads to be a bit wider going forward and not get back to the tights that we've seen earlier this year.
You mentioned 2026 and the setup when you talked about the macro environment. What are the catalysts or the themes that you're watching for next year that investors may want to keep their eyes on?
Yeah, we were watching a number of different things. It's a tricky market backdrop right now. Two of the main macro factors that we're thinking about a lot as we head into next year is the first one, what's the Fed going to do? What's going to be the pace of rate cuts? The Fed is in a very tricky spot right now because the labor market is quite weak. And certainly justifies that thought or that narrative that policy rates shouldn't be at restrictive levels right now. And with the neutral rate at 3%, the policy rate at 4%, that implies 3 to 4 more rate cuts. But at the same time, inflation remains sticky and fairly high. And certainly not at levels where you typically will see rate cuts. So the Fed's got to navigate this narrow road of if they do act too slowly on rate cuts, does the market see that as sort of implicit tightening of financial conditions? But at the same time, if they cut rates too quickly, does inflation start to spiral out of control? And does that cause a forced tightening in some ways in terms of either central banks needing to raise rates to slow things down or the worst case scenario where an asset bubble builds and then it bursts? So how they cut rates, the pace of that, how the economic data reacts to that, is going to be really critical for how we position. Second thing that we're watching very closely is the labor market itself. I mentioned it being fairly weak. What that's created in the US is a two-tiered consumer. You got the high-end consumer. They own a lot of assets. They're getting paid fairly well. They're doing fine in this backdrop. But you got the low-end consumer, and they are struggling to pay rising grocery bills, rising rents. And from a sector perspective performance, it's created haves and have-nots. So you have sectors that have been big winners in this. Financial companies, tech companies, utilities, they're all doing very well. Other sectors are struggling, right? You've got retail, consumer products, home building materials, consumer finance, and there's been some high-profile defaults in the auto sector with Tricolor, Prima Land, and those issues. How the labor market responds to some of the growth expectations we have next year, we see a number of catalysts for growth in terms of fiscal spending, one big beautiful bill, and rate cuts that could prompt growth going forward, will really dictate how those sectors, those underperforming sectors, perform. And if it does have a positive impact on the labor market, that could be create an opportunity for those sectors. If it doesn't, if we start to continue to see the labor market struggle, then those sectors will continue to struggle as well. Within that light, there are a number of sectors that we like in our portfolios that we are exposed to. Some of the sectors that we find exciting include, on the Canadian investment grade side, we really like the retail REITs. Yeah. So retail is a sector that's kind of out of favor, but the management team of these retail REITs very focused on improving their balance sheets. And within that, thinking about how are they going to orchestrate their real estate portfolios to generate better returns. So they've been selling off weaker real estate assets and using those proceeds to pay down debt. They've also been using free cash flow to pay down debt. So we like them as an opportunity to pick up yield, but also benefit from the upside as their credit quality improves.